Welcome back. Well, let's continue our discussion with respect to Q4 earnings. We have with us Mr. Rampraveen Swaminathan, the Managing Director and CEO at Mahindra Logistics, joining us on the show. Hi, thank you so much for joining us. I wanted to begin by discussing your Rivigo acquisition because that is what impacted the numbers in the quarter gone by. When do you expect the break-even to happen for this acquisition at the EBITDA level, PAT level, and have the synergies started flowing in?
I think we've been working on, obviously integrating the business, and that work really catches steam in the first quarter, so it's underway. And we're on track to kind of meet what we've said earlier, which is that we will be EBITDA positive by the end of this year, and hope to be PAT positive early next year.
The management of all cargo and their business for the quarter gone by took a huge knock because of what's happened to the global freight, global business. I'm not comparing your business with all cargo business, but if there is a slowdown in the logistics space, will that also impact your growth for FY24? I think that's the bigger question here.
So I think what we've seen in forwarding really has been a rate correction. In fact, for us in the fourth quarter of last year, volumes actually went up both on air, more on air than sea, but on both. I think as we look forward, I think those price corrections are pretty much bottomed out. And the key thing is going to be to try and get volume growth and accelerate volume growth. We are seeing some upsides there. So from a cross-border perspective, don't expect much to change from a pricing perspective. We do expect to get volume accreditation. We also, earlier this month, launched our air charter brokerage service based out of Dubai. It's a global business line which is based in Dubai. And that should actually give us, further lift on volumes and revenue as well.
I'm asking very basic questions so that we have understanding of FY24. So then FY24, will it be the first normal year because 2020 was COVID, 2021 was extraordinary low impact of, interest rates, 2022 was inflation. Will 2023 be the first normal year?
Hopefully, 23-24 should be a more normative year. I think no real call-outs. I think there is some demand softness in e-commerce, right, and some slowness in network expansion in some other markets as well. But it should be a more balanced year in terms of underlying macros, rather than what we've seen in the last 2-3 years.
What about
and from a growth perspective, we do expect to have a year of growth. We are optimistic about growth in 23-24 as well.
Three large segments which you cater to. When I say, let me specify for our viewers, I'm trying to perhaps understand from you that which are the three large categories like consumer durables, autos, e-commerce you cater to.
So I think we are divided into what we call consumer and discrete manufacturing. That's one big piece, which includes durables and FMCG and so on. E-commerce, of course, and auto and farm. Auto and farm is actually doing well. Both the Mahindra business and our non-Mahindra businesses are doing well. Right. The consumer and manufacturing piece actually is seeing an uptick. Discrete manufacturing has been very upbeat, and we've had a fair amount of our account acquisitions last quarter were in that space. E-com is where we are seeing a bit of softness, right, and new account acquisitions. Have been a little bit, new business acquisition has been a little bit harder for us over the last 4-5 months.
Okay.
Sure. Also wanted to understand, you still have a lot of dependence on M&M business. You have been highlighting in your con calls earlier that the share of the non-M&M business is expected to increase. We didn't see that panning out in FY23. What's the expected share going forward? How is it expected to trend?
Yes, it's hard to take just 1 quarter or 6 months, right? I mean, so the M&M share of our business back 3-4 years ago was probably north of 70%. It's now in the 50% range. The last 3 years, a lot of that's been because the non-M&M business has outgrown the M&M business. This year, obviously, driven by the auto recovery, the M&M business had a strong year. I think from a longer, and therefore there's been a bit more of a balance. From medium to long-term perspective, we continue to believe that our non-M&M businesses, especially driven by consumer e-com and our new service lines, will outpace the revenue from the M&M business.
Anisha was on a channel on Monday and he said, we are firing full cylinders. We are firing full cylinders. Our growth is strong. All our businesses are growing. We don't see that kind of a translation in your business. especially from the M&M business also. Is it because M&M has started outsourcing more to other logistics vendors?
I don't really think that's an issue. In fact, I think if you see our detailed earnings, the M&M business grew, I think, mid to high teens year on year in the fourth quarter. So that's actually continued to do well. Our non-M&M auto businesses actually grew at roughly or even a slightly higher clip than that. So those are actually doing well. Obviously, we are a diversified player, and therefore there are different segments operating differently. If you take out so we had strong growth in most of our businesses. Obviously, that got offset by a sharp decline in freight forwarding because of price corrections, and to some extent because on the earnings side because of the trailing impact of the Rivigo acquisition. Underlying organic growth is still fairly robust, which is probably what Dr. Shah's reference was to.
Like low interest rates, low fuel cost, how will they differentiate FY24 for you?
I think logistics is in the end a derived industry, right? We derive demand from other markets. So as we look at 24, I think we are upbeat about automotive, right, and discrete manufacturing. Both of those, I think, will be strong growth engines. We think the durables and the FMCG pieces will also show moderate growth. We're not seeing the same network expansion which we are anticipating. E-com is where I think for multiple reasons there's both changing business models and network consolidation and slightly softness in demand. That's where we'll probably see a bit of a bump downwards. Overall, I think we're still extremely optimistic about growth in FY23-24 across the business. Just different puts and takes. The last 3 years, automotive was slow. The other pieces outshone the automotive part. Last year, there's been a bit more of a balance. In the near term, probably automotive and manufacturing pieces will outshine others. But that's the strength of having a diversified revenue model.
Before I let you go, a quick outlook on the margins and debt picture for FY24?
Yeah, so I think margins, we have been focused obviously on driving margins and I think improvements. And you'll probably notice the last couple of quarters, our core 3PL business actually has continued to expand margins. And the freight forwarding business has been holding margins as well. As we do acquisitions and scale ups, there is obviously a trailing impact of that. And that's what's actually been weighing earnings down. We do expect that consolidation of margins to continue, right? And that remains a big focus for us in our 3PL business, right? In forwarding, margin improvements should come with volume. The express business or the Rivigo acquisition is where we are really focused on driving a turnaround. And those three big levers, I think, will actually drive a margin and turnaround. From a debt perspective, we're really not a very leveraged business. We have low on capital intensity. Most of the debt on the books has been to fund the acquisitions. And we don't really see any significant change in the debt profile of the company.
Mr. Swaminathan, we'll let you go. Appreciate you joining us on ET Now today. But from one management to another, it's time now to discuss the earnings of V-Guard. We have with us Mr. Sudarshan Kasturi joining us from the company to talk to us about